This is the Rich Dad Stockast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
All right, welcome to the show. This show, we're going to talk about how to prevent losses, which is a big deal with stock market trading. My dad told me the way you prevent losses is you just date a bunch of girls. So then one drops off, you still got plenty more. And that's kind of the strategy I think Andy's going to teach us here is kind of the dating strategy of the stock market. Well, I guess we should all know this. He recently just waxed his whole entire body, and I'm assuming that was to become more attractive as well. But that part we won't talk about. We are going to talk about stop losses, which is a strategy that Andy was just telling me about to mitigate risk, to help stop your losses. And so with that, I'm not going to talk about my dating life at all, and we shall just bring on Andy and the clean-shaven Andy.
You're killing me. We should barely get it together to start this podcast because I lost a little bit of weight, and I thought, well, let's go shirtless on the beach. And I don't know how we got on the topic, shaved or waxed, but I saw the 40-year-old version. I thought I got to try that once and see if it really hurts as bad as it looks. Greg, it hurts every bit as bad.
Yeah, let's get your review on full body waxing.
So we'll try to keep on stocks today, but we had a hard time containing ourselves before we started. So
there were some horrible stories in there, man. Maybe Andy will put it in the show notes, things you need to know, but no.
Better to stop loss, and we can weave in exit strategy at some point.
All right, deal.
There
so
halfway down and leave, right?
How about this? Why don't you tell us what a stop loss is, and then we'll kind of figure out how to use it.
And we'll probably build some big context on when to use one and when not. But a stop loss is simply an order where we draw a line in the sand and we say, look, I'm going to invest some money in this. If it doesn't work out, I'm not going to lose any more than this. I'm drawing a line in the sand. I'm going to limit the amount I'm willing to lose in this. And I'm going to stick to it. I'm actually going to put in an order, a contingency order. It says, look, if I lose X amount of money in this thing, I'm bailing. And that's what a stop loss is. So it's pretty simple. It's what it sounds like. Stop losing money.
It's fully automated. It's not something that it's not a mental thing you're going through.
Mental stops are kind of cute to think about, but no, it's a physical order that you put in, and there's different types, market and limit and good till to cancel. And we can get into all that another day or even today. But basically it's a defensive strategy. What says, look, I'm going to put in an order. It's a line in the sand. How it executes is, minutia, but we'll talk probably more importantly as we begin is when would I use one and do I use one every time? And the answer is, it depends on what type of goal I have. There's a wonderful book that I just love on investing, and I'll do a little encore reading in it. I'll read it more than once to refresh. It's too rich to just read once and say, well, I think I got it all. And it's about intelligence. It's called The Intelligent Investor by Benjamin Graham, who was Warren Buffett's greatest mentor. And it's a book on temperament. And one of the things he says in there is he says, look, investing's hard enough. Trading's even harder. And know the difference between the two. Don't commingle your funds is what he recommends. He says, know when you're doing one and know when you're doing the other. Both can be done successfully, and their strategies are different for each one. So I don't use stop losses in terms of investment. So let's talk about when you wouldn't use one. If you're investing for cash flow, and let's say, for example, it's Kenny McElroy, the Rich Dad advisor for real estate. And he has a project that, let's say it's, a $20 million property, moderate size. And he says, okay, it costs $20 million, and this is how much cash flow we're going to get. If there's a swing in the market and maybe someone to offer him 18 million for it, he's not going to panic and say, oh my gosh, we just lost $2 million, just lost 5% of our investment. He's not going to freak out over 5% swing in a year. He's focused on the rent, the cash flow, and he's focused on the fundamentals of that project, meaning, is it still a fundamentally sound project? Well, the same would be true. Warren Buffett paid, I think his cost basis on Coca-Cola is like $3.25, all the shares combined, cost basis. Well, if his dividend is $1.60 a year, he's more focused on his return, probably in that dividend over the long term as we inflate and Coke gets more expensive, the drink, not the stock, than if the stock were to fall during coronavirus, $7, $8 a share. He says, look, I'm going to leave Delta Airlines because I don't think they're a fundamentally as strong business as I want. So I'll exit there. But that was not a decision on price. It was a decision on fundamentals of the company, not a decision on where the stock price is. So a stop loss is the opposite of that. A stop loss is where we are concerned about the price of that, where Kenny would say, oh my gosh, we lost 5%. Let's sell the whole property. Or Warren Buffett, oh my gosh, stock, Coke went from 60 to 58. Oh, let's run. And so understand that stop losses are not usually something we look at if we're investing fundamentally and saying, look, this is a good company. And, they've had a pullback and a bunch of people in the market have panicked. I really don't care about the stock price. I can still write my calls. I can still collect my dividend. And long term, I still believe in a 20-year time horizon for this company. So that's when you don't use one. Let's talk about when you do. When would I use a stop? Let's say there's something I don't know very much about. Let's say some new ETF comes out, or maybe it's like Snowflake. Maybe it's an IPO. Maybe it's something that I just don't know very much about, but I feel a little bit of greed. I feel a little bit of fear missing out, a little FOMO going on. And I'm just so nervous. I want to trade GameStop with all that craziness goes on. I say, look, I don't know about the industry. I don't know about the company. I don't have any fundamentals on an IPO. But I feel like I want to have some exposure. I want to gamble a little bit. And I don't like the emotional feeling of fear, missing out. And what if it soars? And so that's when I say, well, if you do it, go for the capital gain, go for it if you want. Gold could be an example of this. Buy some gold and say, but this is the max I'm willing to lose. If it goes up, fantastic. I have an unlimited upside. Great. But if it chops down, I'm not interested in riding it out. I'm not interested in a long-term recovery. I'm not interested in that. I just don't want to lose money. So it's a trading mechanism for risk management, not really an investing mechanism.
So can I ask you two questions?
Yeah.
As let's say you did pick your stock right and it keeps climbing, can you keep moving your stop loss up with it?
Yeah, it's called a trailing stop, and you can do that by percentage, or you can do by the number of dollars or pennies or points, whatever you want to do. The problem with stops, whether it's a trailing stop or just out of the gate, the biggest problem with it is called Whipsaw. And what Whipsaw is let's say you buy the stock at $100 and you say, we'll throw out a round number, 95. Say, I'm not going to lose more than 5% of my money in this stock. That's it. That's a lot, right? 5%. To lose 5% of your money, now you got to get 10% to get it back, right? And so, get back to even. So it's kind of tough. You lose half your money in a stock, you got to double the stock to get it back. So what a person will do is they'll get whipsawed. And let's say you have your buying price at 100 and your stop price at 95. Let's say it goes to 94 and you get out, and then it shoots to 120. Right. And so you lost and it bounces back up. And whipsaw is brutal. So how do you deal with whipsaw? How do you know whether to put it at 95, 92, 98, 97.50, $96.72? How do you know where to put that? And so we use a bunch of different things. How would you determine that, right? If it's just arbitrary, I think the worst way to do it is emotionally. Well, this is how much I can stand it. Casinos do not think emotionally. Casinos have position sizing. They have table limits, right? They have certain rules that are unbreakable. And if you go to a casino and watch the temperament of the gamblers, as opposed to the temperament of a pit boss or a dealer, dealers are made out of cardboard. They're stoics. They don't exclaim when things go well for the casino, and they don't despair when the casino has a loss. They just keep turning the crank, right? They're very dispassionate. Where on the other side, the gamblers, when they win, they cheer like crazy. When they lose, they show frustration. And so the danger of trading stock is to treat it like a gambler rather than the pit boss, rather than the dealer. And someone says, well, I just put my stop loss in here because I don't want to lose this much money. That might not be the mathematically correct thing to do. You might be too deep. You might be too shallow for Whipsaw. So the way we determine that type of stuff, Greg, is number one, through the second pillar, technical analysis. We're going to look at some candles. We're going to look at some support and resistance zones. We're going to look at, let's throw out some fancy terms like Fibonacci numbers, standard deviations, volatility numbers. How much does it wiggle? One of my favorite technical indicators personally is an average true range. So I'll tell you what an average true range is. It's how much the stock wiggles on average over recently, right?
So
how much
wait, so how volatile it is?
Yeah. So if it wiggles this much, I put my stop loss tight, but if it wiggles this much, I'm going to get whipsawed. So, this is fine. If here's my stop loss, this is fine, but this is not, right? You can't go down lower and get stopped. So, there's rules of thumb. We teach in the 4 pillars. We talk about 1.5 times an ATR. And that's not just arbitrary, because if it gets outside of its average true range by a certain amount, that tells me something's going on, right? And something negative is going on. I have a reason now, and maybe I combine that with a trend line or some support or a candle pattern. And as you combine all those things, never a guarantee, but hopefully you're right more often. Does that make sense?
Okay, yeah, it clears a lot. I honestly thought when you started talking about the Whipsaw that you were going to say, if a stock's volatile, you don't use a stop loss, but instead you were saying, if you
got to give yourself more room.
Yeah. Oh, that's cool. And you mentioned the 4 pillars. This is something, because you mentioned a lot of words, the candles and the candlesticks and a bunch of, that's all in your 4 pillars class. All right.
It is. And it's important to know when you're trading and when you're investing, because really I'd say the difference is when I'm trading, I'm focused on a stock price. And when I'm investing, I'm focused on business ownership. That's a real important distinction to make. When I'm invested, I'm an owner of the business. I'm interested in our sales. I'm interested in our dividends. I'm interested in how we're performing. I'm interested in our growth. When I'm a trader, think about the, what do they call them? The, now I can't even believe I can't even say this. High frequency trading, right? The super high frequency trading. If they're trading in nanoseconds, they're not looking at fundamentals. They have no interest. Like Coke doesn't change its business in a nanosecond. They're completely focused on price of stock. They're not interested in owning the business. They're interested in trading a stock. And that's the difference. So if you're going to be an investor of a business, stop losses are probably not something you're that interested in, because you're making your decisions based on, do I want to own this business or not? Just like Buffett. It wasn't the price of Delta went down that made him bail. He just says, I don't like that business model anymore. No, I was the opposite. I still think I like Delta's. I think I'm not smarter than Warren Buffett for sure, but I think there's pent-up demand. I think coronavirus comes and goes, and we'll fly the friendly skies again. That's my opinion. So I bought, he sold, but neither of us made the decision based on price. And when you talk about volatility, the reason I lower a stop loss there is I have a greater upside if it's volatile. I mean, the thing if it's volatile, it can go to the moon, right? Tesla can go to the moon. It's a very volatile stock. Procter & Gamble, not so much. Right. So they have different personalities for a trader, and you're going to set your stops in there. Now, the benefit of this that I thought you touched on brilliantly at the beginning of the show, that I hope no one missed, is many people are scared to trade or invest. And the book, The Intelligent Investor, talks a lot about temperament and strength. It takes tremendous strength of character and belief in what you're doing to not hope, but really ride out a tough thing. Hope is not what we're doing. We're not buying and hoping it goes up. That's not a strategy. But if we see a company say, no, that company's still a good company and the market doesn't see it right now, I'm going to be a contrarian, be on this island by myself. I'm going to believe in this company. That takes a lot of guts to be the owner of this when the price is falling, right? So many people can't get over that. And a great way to get over that is start with trading, maybe before you invest, start with trading and say, what am I afraid of? Well, what I'm afraid of is bad outcomes, possible bad outcomes. So I'm afraid that if I'm wrong, I have a bad outcome. So let's back up and say, all right, what if there were 3 crystal balls? One crystal ball says it's going up. One crystal ball says it's going down. One crystal ball says it's going sideways. Well, let's make a plan for all 3. And I say, okay, if it goes up, am I happy with that? Yep, I'm good, right with that. If it goes sideways, I wouldn't be thrilled with that because I'm wasting time. But if it went sideways for 2 months and I didn't lose anything and I got back out, would I be unhappy with that? Probably not. I don't lose money, I lose time. Or maybe it goes down, 1.5 ATRs and I get stopped. I say, well, that's not fun. That's not fun, but could I survive that loss? Well, yeah, I could. I'd survive that. I think the upside potential would be worth it. And I would actually be happy if it tanked. If it went from 100 to 50 and I got out at 95, I live with that. So what that does is it gives me 3 possible futures that I can live with. And I can breathe easy saying, well, I don't know which one it's going to be, but whichever one it is, I'll live to fight another day and I'll be okay with it. And that is a real help to people that have never clicked the button because they're so afraid of losing. All right, well, let's stop the loss. Let's limit what we can lose on this. And if it's a high liquid stock, barring some gap down that's insane, they're not foolproof, but they're helpful, certainly.
So at Rich Dad, we are constantly beating it into people. You got to learn from your mistakes, learn from your mistakes, learn from your mistakes. But just the other day, I got an email and I didn't really have an answer for it. And it was, I can't afford to make a mistake. I don't have much money at all. And I can't learn from my mistake because I won't get round 2. But a stop loss could actually help minimize the size of the mistake. Is that fair?
I don't know that I have the answer to that guy's question, and I don't know that I have the right answer, but I would like to give it a shot and address it. It's a context issue. It's a context issue. It's how he's thinking as an investor as opposed to a consumer. So think about it this way. Let's take someone who's 20, young, and he's got $100,000 to his name. So he's got some time and maybe some time to recover stuff. And you can look at how he should preserve his money and how aggressive he should be. Now let's take someone who's 80 and he's only got $5,000 to his name. How careful does he have to be as opposed to the guy who's 20? What do you think?
Oh, a million times more careful.
See, and that's where my context is different. I think the 88-year-old guy is basically at zero anyway. And because $5,000 is nothing. The difference between having nothing and $5,000 is not that much. Let's say it's $2,500 a month for him to live. So now he runs out of money in 2 months instead of today. So when people say I can't lose they got $4,000 or $10,000 in their 401k, they go, I can't lose to my 401k. I go, you have nothing now. I'd go for broke because I'm broke anyway. That's my mentality, but I'm an aggressive dude, right?
Yeah. You take that old man.
I'm 80 and I'm like, I got $5,000 in my name. I got to pinch those pennies so I can live for 2 months more. Well, you're certainly not going to grow it with that attitude. And the truth of that is making money should not be about how much you have. Let me ask you this. This is a bit of a digression from our stop loss, but it's one worth having. What would Kenny McElroy do if he lost everything? If we took Kenny, and he's got probably $1 billion portfolio or whatever it is, or we take Robert and we say, here's a couple $100 million, distribute it to the poor and you have nothing. Would those guys starve?
No.
What would Kenny do?
Well, he'd find a way to raise money and get back in the game.
Well, he's already has a ways to raise money. Think about this. Kenny and Robert, and even myself to a degree, we invest if we have no money anyway. Our whole systems are built on other people's money anyway, and leverage and smart stuff. So if your business model is based on investing what you have, you're not even in the right universe anyway. The rich invest as if they have no money anyway. So to your buddy, he says, well, I'm worried about the stop loss. You don't have a system of creating money in the first place. And I would recommend to that person start learning about compounding, money, rate, and time. And your key there is rate. You know, how do you get rate? Well, the better rate you go for, the more risk you have, the more risk management you need. Stop loss is a part of that. It certainly is a part of that. If you're going to trade, if you're going to go for cash flow, that's important. So that's an important mindset to have as an investor or a trader, you know, to realize that you could start out. I could start out with zero tomorrow. I could get cleaned out and have to start over. Well, I wouldn't quit. It might not be fun. I don't want to start over.
Right.
But if I had to, I have to. I have no choice.
I did read your book on that a ways back.
I invest with no money.
Yeah.
No money. Yep.
I don't think I have it in the show notes, but
It's a good
I'll see if I can get there.
It's good. But
yeah. All right. Yeah.
So back to stop losses. You want to have related and married to the stop loss is position size, right? Is position size. The casinos are pretty smart in that they have a table limit. Why? Well, it stops people from martingale. It puts a limit on what they can lose. In a way, they stop losing that way. They put a limit on what they can lose in one hand of 21 or one spin of the roulette table. Well, you definitely want to act like a pit boss there. So if this guy doesn't have much, right, that wrote the letter, if he doesn't have much, he says, okay, well, my stop loss can limit that change direction. I wouldn't call it a mistake. This is really important. This is good stuff, Greg. If I invest and the stock goes down and I lose money, is that a mistake?
So I'm going to say from the everyday man, yes.
Yeah, I don't feel that it is.
Right. I realize that's the wrong answer, but
I don't feel
I
like
think most of the listeners would feel, that I made a mistake.
Yeah, and this is why they could really glean from this part of the podcast. Okay. I have to keep reminding everyone of this because it's very hard for people to catch it because we live in a culture of advice. And they call, Buffett the Oracle of Omaha. Let me tell you something. I would say the defining characteristic of the stock market just might be unpredictability. That might be it's defining in the short term. In the short term, the defining characteristic of it might be unpredictability. Let's start with tomorrow. Up or down? Let's go short term. The market going up or down tomorrow. And there's this fallacy. It's a false idea that Andy Tanner, the Rich Dad Advisor for Paper Assets, has an ability to know that when I don't. I have no idea any more than you do where the market's going to go tomorrow. So let's say that I get into an IPO. Let's say that I get into Google at $80 a share when it came out, at $80 a share. And I say, I'm going to buy it at 80 and I'm going to put a stop loss pretty heavy at like 60. I'm willing to lose $20. I'm big, fat. It's going to be volatile. It's going to be all over the place. Okay. If it goes to $1,000 a share, I look like $1 million. Is that because I predicted it was true? No, it's because I exposed myself to a possibility. Okay. Let's go, say as it goes down and I lose and it goes bankrupt and the thing fails. Okay. I lost $20. Is that a mistake? No, because if I had not had the stop loss in, the mistake would have been is letting it go bankrupt or losing more than I had planned to. So the mistake would have been not to invest and just sit there like a chicken, you know what? And the mistake would have been if I do invest, don't have a stop on it. That would have been the mistake. I get stopped out all the freaking time when I trade. I do more investing than trading. But I get stopped out all the time. And when I look at it, I don't look at it as a mistake. I looked at, I did that right. Good thing I stopped out there. I'd have got my ass kicked. Right? So it's not a mistake. So when people say, well, I got stopped out on that, maybe the mistake was you put a little too tight. But even if I use maybe 1.5 ATRs and I got all my stuff there and I got all that and I get stopped out, it worked. It worked. I got stopped out. I stopped losing. How's that a mistake? It worked. It's when I don't have the stop loss in that you have the mistake, if you're going to be trading. So getting stopped out is not a mistake because it's part of learning how to trade. Everyone that trades gets stopped, and learning how to deal with that and understand. Let me ask you this. Let's say look at it this way. Be the casino, not the gambler. If the casino loses a hand of 21, they say, oh, I better learn from that mistake. Better not do that again. I just don't have a sense no, they know they can't predict it. They've just created a system where the odds are in their favor all the time. But in each individual trade, it's very much the same for a professional trader. They have a system where they know they'll have winners and losers, and their system has more winners than losers, or the winners really run and the losers are cut short. Now they have a system, and the position sizes are adequate. Now I have a trading system. Jack Schwager wrote a book long time ago. He wrote another follow-up book about market wizards, is what he called it. And he found the best traders, not investors, not Warren Buffett guys, the best guys that actually traded all the time. And he found as many as he could, really solid guys. And what he found is every single one of them had a different system. No one had found some system that they all discovered, like Newton and Ibanez found calculus at the same time. It wasn't like that. They're all different. But every single one of them had a system. Every one of them had their stops, and everyone had discipline to follow their system. That was the common thread. So one of the things you can learn from stop loss is, oh, I got stopped out. I was wrong. No, you weren't. You were right to have a stop loss in, because you can't predict that stuff any more than a casino can predict a short-term hand of poker. Make sense?
It does.
It is a different context, isn't it? Totally
Yeah,
different.
yeah, of course.
So that's stop losses. So when do you use them? I use them when I'm going for a capital gain. I use them when I'm doing something that I'm not familiar with. I use them when I'm speculating on something. I use them when I've got a small amount of money in there. I use them when I feel the greed that I just can't resist to get into this thing. Okay, get your position size small, get a stop loss, and don't, again, what you said at the top of the show. Okay, now I can say, what's the result of the worst that could happen? Well, the worst that could happen is I lose this much. If that happens, can I live with myself? Yeah, I can. Can I trade another day? Yes, I can. It's a context issue. It's how you see it. I do more investing than I do trading, though. I really do.
I got one last question. Does your broker charge you for using stop losses?
It depends. In the old days, what you can do is you can put in the order. And if it doesn't happen and the thing goes at no charge, the brokers are only going to charge you money when a transaction happens, right? So I can set up as many orders I want. They never charge me for putting in an order. They only charge me if it's filled. And so if I put in buy a stock and the stock goes up and it doesn't ever hit that stop, that line in the sand, no charge. Nowadays, most brokerages, as far as stock goes, it's become so competitive to get the assets under management. They don't charge fees anymore, even for the trade. Gotcha. So there's really, for most brokerages, there's no charge anyway. Trading stop, regular stop, market stop, limit stop, stop limit, whatever, all that stuff. A lot of people do what's called a bracket order, where you buy the stock and you set a target. That's the top bracket, and an exit at the bottom, and whoever gets there first wins. That's a lot of people do that. A lot of people put in a trading stop like you talked about. And I don't mind a trading stop. I just think day to day, the ATR could be tweaked. The technicals are tweaked. So just saying 5%, the market doesn't work in perfect little stair steps all the time. So I like to combine that ATR with trends, with candles, with, different technical indicators, Fibonacci's, maybe a Bollinger Band once in a while. I look at all of it. Say, okay, where would this make a lot of sense to put the stop in?
All right, I'm going to throw this out there one more time. If you want more on that vocabulary, you can get Andy Tanner's
Yeah, there's
courses.
a lot to learn.
Or you can get Andy's free training in the notes, which I always bring up. But Andy, I think you give so much to the show and the listeners that people should be able to get more from you,
I
especially
hope
because you're free.
so. I mean, I hope so. Greg, one day I'd like to do a program just on the idea of what is the education context versus the advice context, because it's so bad out there and people's brains are not wired to invest or to do this the right way. And I think that's part of it is, well, let me put it this way, and we might do a show on this sometime. Police officers, how much training before police officer? How much training do you go through in the police academy before you're allowed to pack heat, go out and get the bad guys?
I'm hoping it's years.
A lot, right? Even if you're going to be a person who cuts hair. In my home state, I think it's 2,000 hours of training. 2,000 hours of training. You put in 10,000, you're going to be really good at anything you do.
Right.
A surgeon, many years of school. A lawyer, many years of not only school, but you might do an intern and you have residencies for med guys. I can't think of any occupation of value that doesn't take a little training. Flipping burgers, probably not a lot of training, but any type of accounting or profession, a true professional. Can you imagine even someone who, like, I loved my blue collar days. I loved framing houses. I loved my labor days. It was fun to learn, get your hands dirty. And I went out and built something the other day that I just enjoyed doing. But I'll tell you, it took time for me to learn how to frame a house. It took time. I didn't show up the first day. So why in the hell, if every single thing we have requires some training, why is it the one day I can get a newspaper or a internet headline that says GameStop going crazy? I open up a Robinhood account that night, and now I'm competing with Warren Buffett as a trader. Come on. And so when we say, hey, check out some of this stuff, do you really get a medical degree off a podcast? I stayed at a Holiday Inn last night and I listened to Stockast, so I should be ready to trade. No, this is really to have people to say, that makes sense. Stop losses make sense. Now, should I learn the details? But we like to keep this big picture.
Yeah, absolutely. I think we have to. The details are for your classes and your courses.
Yeah.
We'll let you handle it there.
Yeah.
Well, Andy,
then we can delve into those.
I do feel I learned a lot. And one thing I'd like to learn more about that you mentioned real quickly, I think you called it a bracket. I'd love if we did a show on a bracket, because that just sounds genius.
Yeah, I don't know. I mean, we have 5 things to look at. The price at which you enter should be strategic as a trader, right? You shouldn't just go buy. You should have a reason for buying at that price. That's one, the price you enter. You should have a target if you're a trader. How much do you think it's going to make? Well, wouldn't it make sense to have some educated guess at least on where you think it could go before you get into it, right? Like people with 401ks, well, how much are you going to make? Well, I don't know. I just put money in there. Well, do you have a target of what you need? Because if you have what you need and the target doesn't match up, you're in the wrong investment. So you got your entry, your price, you got your target, and you got your stop that we talked about. So you have those 3 things. Well, in between those, you have the amount of reward you get and the amount of risk you get. So that's 4 and 5, because I don't know the amount of reward that's there and the amount of risk there. And now I have a risk to reward ratio. And if my risk to reward ratios are favorable, even if you're wrong half the time, you would make money.
Gotcha.
Because every time you're right, let's say you make $10, and every time you're wrong, you lose 5. Well, if you were right 5 times and wrong 5 times, you'd be ahead. And it doesn't always work out perfect in the market, but the idea of a stop loss is a sound idea, again, for speculative investments, capital gain investments, small things where you're just say, hey, I want to throw a little money at this, but I don't want to lose all the money I threw at it. I'd only want to lose this much, but I can't resist the exposure to it. Stop loss is your friend.
I love it. Sounds like a great safety net.
Yeah. So there you go.
Well, Andy, thanks once again. Appreciate it. Appreciate the education. Always learning from you.
Fun stuff, man. Good to be with you.
All
Hey,
right,
I'll just take it for you. Everything in the 40-year-old version is true. It hurts. It hurts, dude.
Well, I'm just more worried about a stranger doing those things to me. But
It doesn't hurt as much as a stock plummeting without a stop loss in it, though. It doesn't hurt that much.
okay,
Put
way
your
to bring
stop-
that back.
See how I worked it in? See, I knew I could
You
work
did great. It's a beautiful segue.
it. Okay, guys.
Andy, see you next week, man.
Thanks,
Bye.
man.